right, everybody, just give us a couple minutes or a minute or so to let people trickle in. Looks like more people are coming in now. Couple more seconds here. All right, let's go ahead and get started. People are still trickling in, but we can at least get the webinar started. So first off, thank you everyone for coming. First off, can everyone hear me okay and see my screen? If you could just reply yes to that in the chat box or the Q&A, either of those would be fine. Or a hand raise is also fine. Okay. Thank you. Looks like yep. All right, good. So we're doing a little bit of a different format today. This is more of a market update and really a Q&A. So a lot of you have submitted questions to us over the last couple of weeks. So we've been working hard to answer those questions. And we're hoping today that we can have a little bit of time at the end to answer additional questions that might arise over the course of the webinar. If you do have a question that comes up, if you could just hit the Q&A box at the bottom and then type in your question, we'll get it. Jamie and Jeff, and I believe Jennifer are also on. So we will receive those questions, and at a point that makes sense, we'll address them, probably more towards the end. All right, so let's get started here. First, because we're talking about investment specifics and in some cases individual securities, it's really important to remember this is a informational purpose webinar, and we're not providing advice here to you on an individual basis. And so any security that's mentioned, we're not saying buy this, sell that. It's really just for informational purposes. If you have questions that pertain to you specifically, you can always contact us. But just please keep in mind that this does not constitute a solicitation to buy or sell any security. So we had a lot of questions that came in, and we thought it would be helpful to provide some background context and considerations as we're going through this webinar, things you want to keep in mind. So many of the questions that were asked relate to what we'll call macroeconomic considerations and how they affect investment decision making. And macroeconomic concepts include things like inflation, what the Federal Reserve is doing, interest rates, politics, geopolitics, right? And all of those things do play a role in portfolio construction, but they are not the entire picture. They're only part of the picture. Asset allocation, individual fund selection, and stock picking are an equally important component of long-term portfolio returns. So we do want to focus on both. More of the question, in fact, all of the questions that came in were macroeconomic type questions, which makes sense because this is a market Q&A update. Another point here is stock market return performance, or excuse me, individual stock performance is driven in large part by decisions and strategy employed by a particular business and those business executives, irrespective of what the overall industry is doing. So some well-known examples of this would include companies like a Netflix or an Amazon. So they're clearly technology companies, but as they've evolved and grown into very large businesses, they are not classified as technology companies in their sector. Netflix is classified as a communication services company, and Amazon is classified as consumer discretionary sector. Obviously, Amazon's market value and shareholder returns are not derived solely by its e-commerce business. In fact, most of the value, one could argue, with Amazon is derived from their technology but cloud business, the Amazon Web Services. So again, just important things to keep in mind when we're talking in broad generalities. Other really important background context and consideration surround, and because so many of the questions were about inflation and interest rates, and we tried to kind of provide a framework that we use to think about this, and we hope is helpful to you. And there have been four major trends that have driven consistently low inflation and structurally low interest rates over the past 20 plus years. The first of those, and this is not in any particular order, it's just all four of these, I would say, were significant contributors to this. But number one here, we have China and other developing nations have effectively exported deflation to the developed world for goods in particular, right? So the US and other developed nations had developing nations who could supply much more inexpensive labor to produce goods. And what that essentially meant was that people here in the US that were buying those goods would pay less for them. So that was what we'll call exported deflation. And we'll come back to that in a second, but that may be changing to some extent. Number two is slower population growth, slower working population growth, and an aging population that results in a lower percentage of working people. Those two are really important to remember because the economy is driven by working age population growth and productivity, right? Those are the two big things, and technological change. Those are the two big things that drive economic growth over the long term. And we've had what we'll call a secular a secular trend where the working age population has been growing at lower and lower rates over the last 2 decades. And then number four is technology and productivity advancements, right? The better the technology, right, the more productive that a business can be with the same amount of supply. So COVID and geopolitical events have likely challenged that number one trend in purple, where it's possible globalization, the move towards kind of globalization throughout the world has peaked, and that going forward, we're going to be looking at more of a multipolar world. And the easiest way I think to think about that is look at the supply chain and the fragility of the supply chain that's been revealed over the last 2 years. The president and senior leaders in Congress have basically said this is a national security issue, and so there's going to be significantly more reinvestment in manufacturing within the United States than there was before. It looks like we might have been having a little bit of a tech issue. I think our internet was a little bit unstable there, or somebody's was. So hopefully everyone can hear me now. I'm just going to keep going on here. So this is really important background. And the other distinguishing thing I would say, and I apologize, I'm not an artist, but I'm going to try to draw this, is basically the way there's two things that can happen. Right? There's something called a secular trend, which is something that persists over a long period of time, okay, but it's slow moving. And so these four were secular, these are driven by secular changes. But then around that secular change, there can be cyclical things that happen, which are shorter in nature, right? 6 months to 24 months. And so just keep this in mind when we're talking about inflation, interest rates, that it's not to say, that some of this might not be challenged, but we do want to keep in mind what has led to these structurally lower interest rates over a long period of time, because you don't want to just dismiss all of these things and say, okay, only these new things that we're seeing now with higher CPI are going to be the future, because it kind of discards some really important underlying trends that have persisted for a long time, and we don't see these three at least changing. Okay. So the first question that was asked, I think it's a really good question, which is this: if you assume there is some not insignificant risk of inflation, what are you doing to hedge that risk in order to preserve capital? Preserve capital, I think what the person is saying is basically preserve purchasing power, right? To make sure that the dollars you have can buy the same goods and services a year from now as they can today. So the first thing I would say is what we've done with all of our clients is looked at an opportunity in the last 2 years to on their personal balance sheet to refinance their mortgage. Rates, 30-year rates, 15-year rates went down to the high ones, into the twos. And so there was a huge opportunity for a lot of people to refinance that debt, which actually, in our opinion, is one of the best hedges against inflation, because for most people, that's one of the most significant expenses, expense line items that they have. And when you lock that in at a low interest rate, right, that principal and interest portion of the mortgage payment is not going to fluctuate over time. 5 years from now, it's still going to be the same amount. And so that is actually a very effective inflation hedge. So I think that's worth noting. Within public markets, which is investing in the stock and bond market, we would rank these assets in order of most effective against inflation to least effective. The most effective, we would say, would be commodities and precious metals, followed by equities broadly, and then lastly fixed income. Commodities, in our opinion, are the most direct inflation hedge. Within equities, we would want to focus on companies that have relative economies of scale and pricing power, right? Amazon's obviously one of the biggest examples of this. Walmart arguably is another one. They have huge economies of scale. And so you want to think about, okay, so they're going to be hurt by inflation, but how are they going to be hurt relative to their competitors, right? If they actually fare better than their competitors, that could be positive for shareholder return in the long term. So relative economies of scale and pricing power. Within specific sectors, you would want to focus on sectors that benefit from higher input costs, things like industrials, utilities, who have the ability to pass on those higher costs to users, materials, real estate, and infrastructure. Within fixed income, focusing on bank loans. Bank loans have a component where the interest rate that the debtor has to pay floats with it floats with rates. So if rates start to rise, the interest payments to the bondholders actually go up. Treasury inflation protected securities have worked well over the last year. That's another area to kind of directly hedge against inflation in fixed income. And then shorter duration bonds. All these positions are less sensitive to rising rates and potentially can benefit from it. Bank loans would also be less affected by a sustained inflation environment due to higher yields. And then this last one I think is really important, which is inflation fears are at a high right now, and that could persist for some time. But the market tends to trade ahead of data. And if inflation subsides in the second half of the year, assets most linked with inflationary price pressures could decline. So this just gives you a quick sense going back to 1960 through, close to about a week ago. You can see here on a relative basis over the last really 20 to 30 years, we're seeing inflation at the highest levels we've seen, really going back all the way to the 70s and the early 80s, where you actually had a very high and persistent level of inflation and even stagflation during the 70s, which we'll talk about a little bit later. So certainly CPI is, year over year up about 8%. Core CPI eliminates more kind of temporary shocks to CPI, which would exclude food and energy. So core CPI is often a little bit more closely followed by economists. This was already rising, and then when Russia invaded Ukraine, it it's added fuel to the fire in commodities. We saw oil hit, 120, 130. It's come back some, but still remains very elevated. So a lot of uncertainty in the commodity markets as a result of that invasion. So next question. Given inflation is already at about 7% year over year, what effect is the Fed raising rates to about 2% in the short term going to do? In other words, is the Fed behind the power curve? Probably yes. The Fed is behind the power curve, and one of the real issues that the Fed faces in this environment is the Fed can only control so much, right? A lot of the inflation has been driven by issues outside of direct monetary policy. Now, the biggest one being the supply chain disruptions. If you look at the U.S., you look at Europe, a very good chunk of that is of the inflation that we're seeing, at least in part, maybe not all, in part, is from the supply chain disruptions. But then we also saw the housing market, because of the limited supply in the housing market, we saw housing prices shoot up. We saw the labor market become extremely tight. And you had about $6 trillion of fiscal policy that was poured into the system back in 2020. That a lot of that was spent, a lot of that was invested. Not all of that went to actually helping people continue to live their life. In fact, the neighbor of mine works for Capital One and within the credit card department. He was telling me as recently as 2 weeks ago that when COVID hit and then the massive fiscal stimulus was given out, he said that there was a huge amount of people that took that money and just paid off their credit card, which again, that's a good thing. But what that says is that they didn't need it for living expenses, right? So either too much was given or not given to the right people. But the point is, too much money went into the system. The Fed can't control, what the Fed can do is control liquidity and the cost of money. But the problem is if at least in part of the inflation is due to supply chain disruptions, so you have limited supply, and some of the commodities that are needed are not very elastic, meaning just because rates are higher doesn't mean people won't buy them. Maybe they need to buy them. That could mean a situation where the Fed, and they're kind of behind the curve, so they're hiking to pull down inflation. They may succeed in pulling down inflation, but if they don't succeed in pulling down the prices of some of those commodities, we could tip. There's a not 0% chance, higher risk now than before, where you could see a recession as a result of that. So they really are in a tough spot. So here are consumer inflation expectations. University of Michigan survey of customers, and what we see here is that the consumer in the short term, like over the next 12 months, is very concerned about inflation. You can see here the average consumer thinks inflation is to be north of 5% over the next year. Over the next 5 years, the consumer is still seeing it higher than pre-COVID, but at 3%. Okay, so what this is saying, and this is fairly consistent with what the fixed income market is saying, which is the short end of the curve has really moved up, right? The 2-year basically went from less than 0.25% to 2% in a period of a couple months. And with that, the 10-year also moved up, but you kind of have a very flat yield curve where the 10-year and the 20-year are still in the 2.5% range, but the 2 years also in the 2.5% range or the 2% range. So, right, that's clearly saying in the short term, inflation expectations are quite high, but the bond market at least is saying over the longer term, they think inflation will subside, maybe not to pre-pandemic levels, but certainly to lower levels. Okay. Next question. If you assume there is some risk of stagflation, where should new or existing capital be invested? So first off, let's define stagflation. Stagflation is a sustained period of low economic or negative economic growth and high inflation. It's an extremely difficult market environment for stock and bond investors. The only period looking back that we found for stagflation in the United States was back in the 1970s. There are some similarities there, but the real major difference between now and then is interest rates. The 10-year Treasury yield during that time period never went below 5.3% in the 70s. It averaged nearly 8% in that 10-year period and actually reached double-digit levels heading into the 80s. So even though we've seen a big move up from on the 10-year 0.7 during the depths of COVID, maybe even a little lower to 2.5% today, 2.5% is still nowhere near close to those levels. Okay, and one of the big differences between then and now, going back to those secular trends we talked about, was labor growth during those time periods was about 2.5%, 3% year over year. Right, today it's significantly lower at about 0.5%. And that trend, that labor growth rate has trended down over the last 30 years. And all the current assumptions based on demographics in the United States is that labor growth will actually continue to decline. So yes, there are some things happening in the world that you have to pay attention to, right? This whole idea of, where are we going to get energy from? Where are we going to get these commodities from? We can't just rely on Russia and China and a lot of these countries where their geopolitics are very different, their objectives are very different, how they operate is very different. So that's clearly been brought to light, but you still have this secular trend of this low labor growth rate and declining labor growth rate that's acting as a balance. So there's this kind of push and pull between inflation as a result of supply demand dynamics, especially in the commodities and energy markets, but then these longer term secular trends which still have not changed. Okay, so during the 70s, real estate, housing, commodities, and energy work best. So if your position is we're going to be entering into a period of stagflation, or there's some risk of it, we still think that risk is low. But to the extent that was a concern, you would want to focus on companies that benefit from commodity exposure, right? Copper and aluminum are a good example, right? There's only so much copper that can be produced through so many mines. And so if you have a tight supply, which we do, and demand continues to grow, that's going to result in higher prices of copper, and copper producers would benefit from that. Other areas that would benefit in areas of stagflation on a relative basis, you'd want to be looking at value stocks versus growth stocks. So, stocks that yield a dividend, mid-single digit organic growth, recurring revenue business model, disciplined and intentional capital allocation procedures. Looking for fixed income and yield producing assets, again, bank loans, multifamily real estate would be places to look. And then technology still does play a role, because businesses, if their costs are going up, they need to figure out where they can become more efficient and more productive. So they're going to be looking aggressively at implementing technologies to help them lower overall costs and increase productivity. Big tech continues to be an area that would benefit from that, in our opinion. Companies like Microsoft, Amazon, Alphabet, which is Google, and Adobe would be big beneficiaries of that, in our opinion. Do you recommend purchase of real estate or other hard assets to offset inflation? So we wanted to make sure that we were clear on this question. So direct real estate investments would be where you're going out and purchasing real estate directly, right? You own the asset, you're taking on debt potentially to own the asset, but it's just you. So that is a lot riskier for individual investors, because it requires significant upfront capital, niche expertise, and there's not much liquidity. Within public market equities, I think interesting places to look within real estate wouldn't be really office real estate per se, generally, to hedge inflation because of the new hybrid work environment, but certainly assets that relate to infrastructure. So that could be, data centers, cell phone towers. So as the world digitizes, decarbonization trend continues. Here's some examples of real estate companies that would, we think are attractive or interesting in this environment, potentially. Brookfield Asset Management, American Tower Corp, and Crown Castle. T. Rowe Price did some research looking at the past periods where core CPI exceeded 3.9%. And so what this chart looks at is the mean annualized asset class performance when mean core CPI exceeded 3.9%. And it's nice the way they did it. They show you the full year period and then half periods, kind of the first half and the second half. And there haven't been that many time periods where we've had core CPI sustained above that 3.9% level. We'd have to look at October 73 to April of 83, November of 83 to October of 86, and then 87 to January of 92. Again, this doesn't mean that this is going to repeat itself. It's just looking at other periods of time where inflation was running hot and how did asset classes perform in that environment. And so you can see here, real asset equities, kind of similar to the question that was asked, things like precious metals, real estate, or commodities. You can see real estate and commodities were two of the best performers. Commodities did better in the first half, a little bit less on a relative basis in the second half of the inflationary period, but overall strong. And then real estate, strong overall, strongest performer in the past. Again, 13.5% in the first half and actually stronger in the second half. Precious metals, interestingly, did worse in the first part of an inflationary cycle and then better in the second half. And then what was surprising to see was, stocks in general. So large cap stocks, large cap growth stocks, large cap value, small cap stocks, and international stocks all performed, on a relative basis, nominally positive. But you'll see in the first half of the period, stocks did lag, right? You could see large cap stocks, growth stocks in particular lagged, and then really came back with the resurgence in the second half of the cycle. So, right, this is kind of this situation where a lot of times I think there's the tendency to say, okay, inflation's here, it's not going away. We don't know how long it's going to last, but let's direct a much more significant portion of the portfolio towards real assets. And I think you want to be careful of doing that because, especially in this type of a market where so much has changed within the last 2 years since the onset of COVID, if you think back to a year ago from today, so we're talking end of March 2021, very few people, if any, were talking about inflation and rates, right? The Fed was still talking about not raising rates until 2023. Okay, clearly the Fed pivoted hard towards the middle back part of last year and became much more hawkish, realizing they were behind the curve. But again, when the pendulum swings, it oftentimes swings too far in both directions. And so we want to try as much as possible to kind of be balanced in how we react to these situations, knowing that you can overshoot in both directions. And we think that that's a real possibility that a year from now, again, it's not that inflation is not relevant. It's just it's not controlling the entire conversation. Okay. So you can tell from these questions that there's a fair amount of bearishness and pessimism out there. So what do you think are the odds of recession in the near to medium term? And what should we be doing to protect against it? So the odds are certainly higher now than at the beginning of the year for a recession. We don't think we're there yet, but certainly if we have some bad policy mistakes, or if certain parts of what the Fed is trying to do are not accomplished, we could certainly see an inflation. I think the biggest risk is that the Fed raises rates, which does bring down demand, but the prices of a lot of these commodities and energy that we're consuming do not go down. And so if you have both of those, that could easily kind of tip the scales. So we're keeping an eye on that. Consumer sentiment, here's all the reasons to be bearish. Consumer sentiment is at multi-year lows. The yield curve is now inverted, which doesn't mean a recession's coming, but it's certainly a warning sign. Inflation is squeezing the consumer. I'm sure everyone here is feeling that to some extent. Liquidity conditions are tightening, right? Less money in the system. Fiscal stimulus is wearing off. So places to look. We've said this before. For many people, for many of our clients, we have tilted the portfolio towards utilities. Utilities we like as a sector. It was really out of favor from mid 2020 through really most of 2021, but in the last 6 months has been a huge outperformer. It's one of the most defensive and recession proof of the sectors. It has recurring non-cyclical cash flows. Still, the sector as a whole is paying out about 2 to 3%. Earnings have grown consistently in the mid single digits, in some cases mid to high single digits. So again, there's on a relative basis, when you're looking at the other areas of the market, we think that it's fairly attractive. So something to keep in mind. Focus on dividend paying stocks that pay a dividend with ideally non-cyclical durable cash flows. So another place to look there would be something like healthcare, life sciences tend to have non-cyclical cash flows. Ironically, if we do get a recession, interest rates would likely retreat as demand contracts, and longer duration assets like technology stocks, growth stocks, things like that could actually outperform. Technology and growth really took a hit from basically fall of last year. I mean, they're still hit hard, but through, basically beginning of March. And so it's possible we've actually seen a lot of the route that in that sector as a result of all the things we're talking about here, right? The market tends to be a leading indicator. So, higher inflation, tighter liquidity conditions, all those things are generally put growth, longer duration stocks out of favor. So we saw a pretty big correction in the NASDAQ. It was down about 22%, I think, roughly from peak to trough. It's now come back to about half of that. So it's down about 10%. So again, market moves very fast, and we don't think we're out of the woods yet. But the market has recovered, had a nice recovery here, but we don't think we're out of the woods yet. There's still a lot of things to keep an eye on. The next question, the Fed hasn't explained how it's going to divest itself of all the quantitative easing buys it has made over the last few years. What, if any, impact will that have on the economy and inflation? So just to rewind and review here, the Fed has a dual mandate. Number one, price stability, and two, maintaining maximum employment. Okay, the number one mandate has been violated, right? We don't have the price stability that the Fed wants, aka inflation is too high. And so the Fed is responding to that by raising the federal funds rate. They've only raised it 25 basis points so far, but the market has completely priced in them hiking another 7 to 8 times over the next year. And Powell has made it pretty clear that he intends to do that, and that the economy is strong enough to, withstand that. So that's basically been their first step in normalizing to a post-COVID economic reality. The second step of that process would be to decrease the size of the balance sheet, which is what this question is getting at. And what we would say there, Powell didn't even give a really good answer for this question. So, we're probably not going to do much better, but they've made it really clear in all of the meetings that the process is going to be dynamic and based on market conditions. So, they're not going to just continue to raise rates or take away supply from the, to let the balance sheet roll off if they're seeing data that where demand is contracting rapidly and things like that. So in general, adding a supply of fixed income assets to the market will reduce liquidity and make money more expensive. And this will work as long as the employment picture remains solid, right? If all of a sudden the employment picture doesn't remain as solid, then that strategy, they would have to change course or modify it. If you want to think about how these things ripple, how the Fed's activity ripples into the overall market, an easy place to look right now is mortgage rates, right? Mortgage rates were kind of very low. They drifted up a little bit, but then all of a sudden they went from like the 30-year at 3.25% to now it's north of 4%. So that's an example of the impact when the market, when liquidity conditions tighten, and they are, and it's happening pretty quickly. That's the type of reaction. So, I mean, that's, in our opinion, not insignificant, because now a 30-year mortgage is materially more expensive than it was, even 6 months ago. And so what effect will that have on housing prices? I think it remains, it's, a little too early to tell. These things tend to have a lag effect, but it's something that, we think will have at least somewhat of an effect, but we have to wait and see. It's one of those, we need to monitor the situation. This is just a look at the Federal Reserve's balance sheet going back to 2008. These are in trillions of dollars. So before the great financial crisis, the Federal Reserve's balance sheet was about at 900 billion. And then, as you can see here, quickly rose to over 2 trillion after the Lehman Brothers collapse. Then we had QE2 and then QE3, right? Trying to spur the economy, get people spending, keeping interest rates low. So that was a long and sustained recovery. And really, you could see here when QE3 ends, you see this kind of plateau and the balance sheet kind of drifting lower. What they're doing there is, as these bonds mature, they're just not purchasing new ones. And so it goes into the open market, which decreases the size of the balance sheet. Then you can see again, COVID hit, massive policy response. To the point where really from before COVID to now, basically the balance sheet has doubled. Now we're at a level of 9 trillion. And we would likely see that it would follow a similar trajectory to this as it tapers. It's likely to be a little bit more rapid, just because the Fed is behind the power curve a little bit here. Maybe more than a little bit. And then again, some historical context for interest rates. This is the 10-year is in kind of that dark blue to black, and then the orange to yellow is the 2-year. So you can see going back to the 80s, the 10-year peaked at about 15.84%. Now what you're seeing here most recently, in particular, see this 2-year move? That is a really sharp, fast move. So it's and the absolute level is not high, only still at 2% or so, right? But the speed at which it increased has shaken the market, okay? And you don't really see a period before. I mean, here, in the 90s, you saw a pretty rapid rise. But again, for our recent history, in the last 20 years, this is far the fastest that rates have moved up on the short end of the curve in a long time. Okay. And so when the rate of change is that fast, the markets they seize up. And that's what's happening. That's what was happening at the beginning of the year, and to some extent, it's still happening. So if the Fed increases interest rates to combat inflation, is it now time to move assets from cash to bonds and other income-producing assets? So yields have already adjusted upward sharply, right? The market moves very quickly. It's already pricing in. Fed's going to raise, to the short-term Fed funds rate to about 2% within the next year. So that's already priced in. Now, the bond market is also signaling, right? If you look at the 10-year, it's risen, but it's not at 4, 5, 6%. It's at 2.5%. And the 20-year is, I think, slightly less than the 10-year. So The bond market, the fixed income market, is signaling that inflation will subside over the long term. And of course, today could be different, but probably not as bad as many think. So to the question, beyond a comfortable emergency reserve to help you sleep at night, which we like to think of as 3 to 20 months worth of your living expenses, could be more if you just want to have that kind of peace of mind money. But beyond that, right, your cash is basically not producing anything for you. So we would recommend allocating that money to a balanced and diversified portfolio, which would include bonds and income producing assets. Income producing assets could be either fixed income or equities. Income producing assets, an example could be utilities. We've talked about that before. Real estate, that's another example. The utility sector we already talked about, it's yielding about 2 to 3%. Non-cyclical, durable cash flows, right? People need to keep the lights on, grows consistently, and it's generally, as a sector, less volatile than the overall stock market. Okay, here was a question we got. Excellent question. In order to ensure the portfolio lasts through a person's retirement, what is the appropriate withdrawal percentage? So the rule of thumb has been 4% for a long time. Again, rule of thumb, not a law. And now 3.3% is being discussed. And then the second corollary to that question is, what is considered the average duration of a retirement? And the answer to that is 30 years. That one, all the studies are going to look at a 30-year retirement. So Morningstar published a 59-page paper, 2021, on exactly this question. Determining the appropriate withdrawal rate is a combination of assumptions. One is, what is the retirement duration, right? It's inherently uncertain. So the assumption is 30 years, retire at 65, live to 95. I think that's a pretty conservative assumption. What is the asset allocation? Could be 100% stocks, 50% stocks, 0% stocks, right? Depending on that allocation, that's going to drive the most sustainable withdrawal rate. What are the expected returns, right? If we were to assume returns in the last 10 to 12 years repeat themselves in the next 10 to 15 years, we're probably looking at significantly higher withdrawal rates than what's showing here. But the study doesn't. It assumes, a more normalized future returns of 6 to 8% in stocks. What are inflation levels going to be, interest rate levels, and what is the desired confidence level of success? So meaning, one couple may say, well, if we look at this over a 30-year period and we do a Monte Carlo analysis and 90% or 90+% of the time we have success, we're fine with that, but we don't want to go below 90% success. Whereas some people may be comfortable with 75 or 80% success, right? So depending on what your confidence level is, or what you want your confidence level to be for retirement, that's going to drive your withdrawal rate as well. So what Morningstar used, what we think are some of the most conservative assumptions, and they looked at all different portfolio allocations, but the main one they looked at was 50% stock, 50% bonds. And what that supported was starting with a fixed real withdrawal rate of around 3.3% per year. So let me explain what that means. What that means is, let's say in the year of your retirement, and let's just disregard taxes for the time being, you have $1 million in your portfolio. Okay, assuming a 3.3% withdrawal rate, fixed real withdrawal, what that means is in year one, you could take out $33,000, okay, from the portfolio. But then in year two, what you would do is you would take that 33,000 and then you'd look at whatever inflation was over the previous year. So if it clocked in CPI at 4%, you would increase your 33,000 by 4%, and that's the amount you would take in year two. And then you do that in year three, year four. So the amount you would get starts at 32,000, but then it would go up every single year, whatever CPI inflation rate was. Okay. And that showed under those conservative assumptions over a 30-year time period, 90+% of those trials were successful. Now, there's ways to tweak this, and they looked at different things. And one of the ones I think worth mentioning is forgoing the inflation adjustments method. Okay, so it's a slight tweak to the one we just went over, where it modifies the approach slightly by not taking the inflation adjusted amount of the withdrawal in only years where the portfolio declined in value, right? So let's say $1 million, you take out initial amount, okay, and then the first 3 years after that, portfolio is neutral to positive, and inflation was positive. Inflation clocked in at a positive rate. You would get a pay raise each of those years. But then in year 4, let's say the portfolio was down, okay, and inflation clocked in at 3%, you would not take that 3% increase. By making just that one change of not taking the inflation adjusted increase in years where the portfolio was down in value, you could increase your starting withdrawal rate to 3.76%, which is a pretty big increase over 3.3. Higher levels of inflation necessitate the need for higher income producing assets, exposure to bonds and stocks, and remaining balance, right? The more cash you have in an inflationary environment, the worse off you're going to be, because cash is not providing you with anything, right? It's essentially, you're just guaranteed to lose whatever that value is to inflation over the course of the year. So the last 2 bullets I think are really interesting, and this is really has to do with what your goal is, right? What are your legacy goals? What are your retirement goals? If your desire is to leave assets to the next generation, okay, and that's a priority, that would lend itself favorably to the 3.3% approach, fixed real withdrawal, meaning you start at the 3.3% of your balance and then increase it by inflation each year. That's the most conservative route and will leave the most money to your heirs. A more dynamic approach, right, like foregoing inflation, for the foregoing inflation method, or something called the guardrail approach, which is where you take out more in a positive in a year where the portfolio is up a nice amount, but actually take out less in a year where the portfolio is down, actually results in a more efficient spending of the portfolio assets, but less money at the end of life. So if your goal is, well, we really want to enjoy our retirement and maximize, our lifestyle, and yeah, like it's great if the kids get something, but that's not our priority, then the dynamic approach is going to allow you to take more from the portfolio over the course of your life. Next question, how long does a typical correction take to recover? So this goes back to World War II, looking at the S&P 500. Market corrections are peak to trough declines of 10 to 20%, which is what the S&P went through. You can see the average decline is about 14.3% during the average correction, and the average recovery takes only about 4 months. Sometimes it's longer, sometimes not as long, but that's the average, okay? So that should answer your question. This is, again, just a look at the volatility of the market over the last 42 years. And we've shown this before, but I think it's always worth reminding people that volatility, while unnerving, is a normal part of being a long-term investor, especially in stocks. And you can see here, each of these bars represents the calendar year return going back to 1980. So 81, 82, 83, 84, and so on, all the way to 2022. But the red dot under each of the bars shows the intra-year maximum decline that was experienced. So in 1980, the market as a whole was up 26%. But during the course of that year, the market was actually down 17%. So really, actually, you can see, especially in here, very high levels of volatility in the 80s. Now, returns ended up being positive for many of those years, but if you were looking, year to year, it would feel extremely volatile. And then this year, you can see intra-year so far, we've seen a 13% drawdown from the peak. Now that's back. This was run late last week, so maybe the S&P is down 4 to 5% versus 5 year to date. So still a lot of time left in the year. We don't know where we're going to finish, but this is not that abnormal. It's abnormal relative to 2021, 2019, and other than just the huge drawdown when the pandemic started. But we've had a number of years, only -3, -7, -5, that can lull people into a sense of complacency of the market's always going to go up. That's not true though, right? The market over time has historically gone up, but there are plenty of time periods where volatility can be elevated. So again, it's not that unusual what we're seeing now. Okay, so that is the end of the prepared presentation answering your questions. I'm not sure if any questions have come in. If they have, please go ahead and put them in the Q&A. So, okay, it looks like breaking up consistently. So hopefully that has subsided. Question that came in, what about cybersecurity, artificial intelligence, and machine learning? Also, Buffett was talking about Coke and Pepsi. So cybersecurity, AI and ML, artificial intelligence, machine learning are certainly, especially artificial intelligence and machine learning are, huge trends that we would say are still in the, first inning. So, you've seen a lot of the big technology companies invest heavily in artificial intelligence and AI. Alphabet's probably the biggest example of this and has some of the most powerful AI and machine learning capabilities. But basically, artificial intelligence and machine learning shown have been most effective the larger your data set, right? So they're running these algorithms based on the data that they have, and the more data you have, the better the algorithm is, the better the outcome. So they're investing directly into artificial intelligence and machine learning. There's different ways to do that. We actually think that big tech continues to be an attractive place to do that because they have some of the biggest investments in those spaces. But certainly there are other companies that are emerging that are focused more rigidly on AI and machine learning. But I would just say, like, yes, it's a new technology, and yes, there's going to be some huge winners in that space. But a lot of the benefit of AI and machine learning could come to companies that are utilizing that technology. An example could be something like the railroads, right? The railroads have a huge amount of data from all the different shipments they make, coordinating the rail cars, and it's a huge logistics operation. And they've been using AI and machine learning to make their routes more efficient, to better serve their customers, which has helped make them more productive and bring down their costs. So, how do you, from an investment perspective, you could look at AI and machine learning as being a tailwind for some larger companies that are able to utilize them to make their cost structure more lean. And then there's other ways where it's more of a direct play in something like an Alphabet where you're investing. Cybersecurity was also mentioned. That certainly is a very big area. It's a huge focus for companies and countries going forward. It's not necessarily an issue, but it's still, I think, when you're looking at cybersecurity in the context of inflation and interest rates, it's still lumped in, correctly or incorrectly, under the tech umbrella. And so when the market is selling off longer duration assets because of inflation and higher rates, okay, less liquidity, if you look at baskets of cybersecurity stocks, you'll see that they also were prone to a lot of the declines we saw in the overall tech space over the last 6 months. So certainly an area of interest and focus going forward, but it's not, if we're looking at a stagflation environment, or a recession, I'm not saying we are, I still would think that some of those cybersecurity companies, they're still priced very expensively. And so you can still see a meaningful contraction in them. Doesn't mean that the spending towards them won't go up over time. We think it will, but you still have to factor in what the valuation is and the trade-off there. And for the right risk tolerance, it can make a lot of sense. Any other questions? All right, great. So what we will do is, as always, we'll send out the recording of the webinar. And if anyone has any questions they would like to discuss with us offline, we'd be happy to do that. Thanks again. We hope you have a great day and talk to you soon. Bye-bye.